Capital raising can be either a highly rewarding or an extremely frustrating experience. Sometimes you get excellent feedback, people are fascinated by your campaign and spread your messages in their network, which eventually leads you to closing the round successfully. In other cases, it feels like a waste of breath, backed by a feeling of uselessness. The difference between the two cases lies not in the track record of your team or the quality of the product. It's in identifying the right target audience of investors and engaging them with a compelling story. In this video, you will learn how to pick your investor audience so that your fundraising ends up a success instead of being a waste of time and money. My friends, welcome to Stobox Insights, a video series about capital raising and innovations in finance, brought to you by an award-winning consulting and technology company. Visit our website to learn more about our products and services and how they can benefit your business. There are 3 reasons why finding the right target audience is vital for reaching your fundraising target. First of all, it allows designing the token in a way that would be attractive to your audience. The same investment can be represented in a myriad of ways. For instance, you can give investors extensive participation in share capital, which will be riskier and more profitable solution for them. Or you can stick with a fixed income, which offers higher risk protection at the cost of lower upside potential. There are also many hybrid options discussed in detail in our video on token economy, which I encourage you to watch after this one. The choice of investor audience defines the type of product you should offer, the risk level, payout period, payment frequency, etc. Structuring the token such that it's relevant to your audience is an important factor in the success of your offering. That there are other factors, such as nature of your business and your preferences as founders, that impact the type of token. So you may choose a reversed approach, commonly favored by our clients. Design a token first and then choose the audience based on that choice. Secondly, knowing your audience allows sending correct messages. For example, to communicate with a rather sophisticated audience, you can discuss a risk-return profile or a projected financial ratios of the investment in question. Accordingly, for a less sophisticated audience, you may focus on simple numbers, such as annual yield, and rely more on the narrative behind your offering. Different audiences care differently about returns, risk, social impact, or innovativeness. Any of the above might be a decisive criterion or may be disregarded completely. This is why understanding an audience defines the messages used in a marketing campaign. Thirdly, your segmentation determines the marketing channels that are to be used. The proper channels of finding an investor largely depends on the type of audience you are targeting. Generation Z investors will probably be accessible on social media platforms like Twitter, TikTok or Instagram, probably not even Facebook. On the contrary, the audience consisting of regulated funds requires quite a different approach. You should reach them out via email, LinkedIn, or even visit the offline events to network. One of the previous videos on these channels go into a deeper discussion of marketing channel. Make sure to check it out if you are interested in the topic. Now that we discussed the importance of picking targeted investors wisely, let's determine how exactly you distinguish between them. The most common approach is to assign a set of parameters by which investors differ and rank each audience according to those parameters. For example, you may target non-sophisticated, risk-hungry investors who allow innovation and quick payouts and who made their first money on the latest boom and are now looking for new opportunities. Alternatively, your ideal investors may be sophisticated developers from Silicon Valley between 25 and 40 who invest primarily to retire early and look for great deals to maximize a risk-return ratio and to feel smart. The first parameter to consider is the risk appetite. It has a rational and irrational components to it. From a rational perspective, it defines which returns investors expect and how much risk they are ready to take to achieve those returns. It also depends on how this investment fits into their overall portfolio. Psychological aspects of a risk appetite include the need for stability and control, or vice versa, excitement and anticipation of a gambler. The matter of expected returns is close to the risk appetite. Although the risk usually correlates with returns, some investors might not be aware of this connection. You should be prepared that some of them will be expecting high returns at moderate or even low levels of risk. A factor that recently has risen to importance is ESG preferences. ESG stands for environmental, social and governance aspects of your companies. It's a trend that cultivates investing in companies who aren't simply making money, but also take their responsibilities regarding environment and broader society seriously. A hugely important factor is whether your investors are institutional or individual. It matters because the way you receive funding from a fund completely differs from how the individuals, even the richer ones, are investing. It impacts your outreach channels, the investment horizon, the degree of involvement in management, the depth of due diligence, and the additional support you can receive beyond money. If you target institutional investors, you must understand the type of institution you are working with. It may be private equity, venture, crypto or hedge fund, or even something more traditional like a pension fund, family office, or a mutual fund. It's ideal to target funds with a specific investment thesis, i.e. a specific type of deal the fund is looking for so that you fit into the thesis. The next thing you have to understand about your investors is industry preferences. Many investors don't have such preferences, but more sophisticated ones, and especially institutional, are likely to specialize in a particular field such as real estate, manufacturing, or Web3 investments. You can achieve a much higher conversion rate by targeting prospects particularly interested in your industry. Your communication will be highly impacted by the degree of investment sophistication of your audience. It determines how good your investors are at the investment math and how capable they are of conducting due diligence on their investment opportunities, assembling a portfolio, etc. We made a video about financial parameters that investors most commonly assess. Take a look at it to become even better at communicating your offering. A similar factor is the degree of technical sophistication, which measures how much do your investors keep up with technologies, how easy the process of token purchase will go for them, how much will they require additional support, and how complicated can your vocabulary be while you're conducting the marketing campaign aimed at those people. The following comes the check size. It may be $500, $5,000, or even $100,000. All of the possible figures stand for different groups of investors who conduct due diligence of varying depth, make more or less emotional decisions, and are acquired through different channels. Notice that your check size may also depend on factors beyond marketing, such as legal limitations on the number of investors or the transaction cost. The investment horizon points out how quickly investors expect to get their returns or make an exit. More aggressive investors will rather go for short-term investors, while risk-averse investors will set a goal of maintaining and steadily increasing their capital. In the case of institutional investors, it also depends on how much time they have until the closure of the fund. One of the benefits of tokenization is that it reduces short-termist pressure to create liquidity for investors with shorter investment horizon. Using the DS swap technology, you can enable trading for your investors much faster without going into M&A or a public offering. Watch the video by the link in the right upper corner of the screen to learn more about this technology. You can also read about it on our website. A quite useful factor is a demographic profile, which includes things such as age and gender. Though it doesn't tell you directly about investment preferences of your audience, many advertising agents use demography as a primary targeting tool, so it makes sense to consider which demographic profile is likely to have the characteristics you seek in your audience. You may also have a product that is targeted at a specific demographics. If, for instance, your business is a woman-led business, you can prioritize female investors. Following the same principle, take geography into account. Firstly, it determines the language you will be using. Secondly, certain messages may or may not be acceptable in a specific culture. What also matters is that particular investors prefer giving their money to their domestic businesses first, to raise their country's economy, while some invest offshore to achieve better diversification. The last and the most complicated thing to account for is the psychological needs satisfied by the investment. People make investments not with the sole reason to earn money. They also aim to feel a certain way, achieve social impact, or resolve personal gestalts. It may be a need for status, which may be fulfilled by investing in something luxurious or exclusive, or in some regions by a mere fact of making investment. For some people, this psychological need is affiliation and the desire to become a part of the community. Some people value the feeling of making a difference and making the world a better place to live. Some investors just need to prove they are different. In this case, the investment is a type of self-expression. A desire to go hand in hand with technology and innovation is also a tangible psychological incentive. A psychological motivation to invest may come out of various emotions. Understanding the psychological needs of your investors will allow picking more tailored messages that will hit the right buttons in the minds of your audience. The characteristics above correlate with each other. For example, aging usually goes along with the reduction in the risk appetite. The bigger the check, the more sophisticated you can expect an investor to be. Such a correlation makes it easier to compile a coherent ideal investor profile. If you find this video useful, don't forget to press the like button so that more people can find out about it and support the channel. Also, if you have people in your network for whom this information may be helpful and save their fundraising campaign, make sure to share this video with them. When discovering your investor audience, you can use as a guidance the following 5 rules. Rule number 1 suggests thinking about what kind of product you can offer. If you offer a good old-fashioned rental real estate investment that promises a 5% annual return, targeting risk-hungry investors won't make sense. Although the product indeed can be modified, i.e. reflect your real estate with metaverse, it won't change the business in its essence. Rule number 2 is about knowing the fundraising goal and the regulation you are working under. If you want to raise $50 million without registering your offering with any regulator, you would have to target accredited or even institutional investors, because you wouldn't be able to raise this figure legally otherwise. Rule number 3 is subtle yet powerful. Aim to attract investors you as a person and your team are comfortable targeting. If the main thing you love about your company is its innovative narrative and you strongly feel that it's the key selling points, you should go for it. It's easier and more efficient to sell something you have a great passion for. Another, more pragmatic example: imagine that your marketing team is skilled specifically in B2B marketing, which makes it easier to target institutional investors than to already having a bunch of ready-to-use channels and creatives. Rule number 4. Use as a basis a profile of your existing community, if you already have one. It most likely will be your primary target audience, so you have to pick messages that will not alienate it at the very least and help expand it as the best case scenario. Rule number 5 is that you mustn't stick to one and only audience. You can target several ones, provided that you use appropriate messages and channels for each. It's actually even better, as you cannot know in advance which one will be the most receptive to your offering. In the initial stage, you would probably launch multiple low-budget ad campaigns to see which one will give the highest return on ad spend and which audience will like the offering better. This will eventually provide you with the idea of which exact audience is your best pick. In some cases, you can even offer different tokens for different audiences to better suit the needs of each one and maximize your capital raising capacity. However, such an approach complicates your capital structure, which must be communicated to investors and lenders. If done incorrectly, issuing multiple tokens can harm fundraising prospects instead of helping. Although investment marketing is complicated, if done right, it will turn out to be a profoundly gratifying experience that will bring you many fascinating people willing to support you and your dream project. Stobox, along with a network of our marketing partners, is ready to give you a hand in your journey of designing your offering and finding investors. Feel free to book a complimentary 30-minute consultation with Stobox specialists by filling in the form on our website stobox.io or writing us at info@stobox.io. Stay tuned and see you in the next episode.